Welcome back to the channel. Today is June 30th, 2025, and we have a lot to talk about. The financial world has just gone through another whirlwind, and as always, we're here to break it all down for you. From the collapse of the US dollar to the S&P hitting new records, the Federal Reserve coming under increasing political heat, hedge funds fleeing oil, and Bitcoin holding strong, it's all unfolding fast. You need clarity, insight, and action, not noise. So stick with me because these 30 minutes could change the way you invest for the rest of the year. This morning, the US dollar fell to its lowest level in nearly 4 years against the euro and sterling, and even worse against the Swiss franc. It's a brutal move that's catching global attention. The drop isn't just about rates, it's a mixture of political pressure on the Fed, optimism around trade deals, and market expectations that interest rate cuts are now almost guaranteed. Traders are rapidly dumping the dollar in favor of other currencies, and the global FX landscape is tilting. Driving the dollar down further is a wave of international optimism. Canada just backed off its controversial digital services tax, while negotiations with the EU and China are showing signs of real progress. Markets love it, and when you add to that the expectation that the Fed may slash rates as early as September, you get a perfect storm for dollar weakness. The futures market now prices in a 93.3% chance of a rate cut in September. That's almost a lock, and Wall Street is positioning for it. But there's more to a weak dollar than just interest rates. It changes everything from how much you pay at the pump to the price of electronics and food. Imports get more expensive, inflation picks up. But on the flip side, U.S. exporters win. Companies like Boeing, Apple, and Microsoft, which earn globally, are seeing profit margins expand thanks to currency translation. It's a classic double-edged sword, and investors are trying to figure out which edge to grab. Meanwhile, U.S. markets are on fire. The S&P 500 and the Nasdaq both hit fresh all-time highs today. What's fueling it? A combination of strong Q2 earnings, easing fears about trade wars, and, no surprise, the belief that rate cuts are coming. Big tech is leading the charge again, especially AI-driven giants. In fact, this quarter alone, the Nasdaq is up over 17%. It's been a stunning turnaround from the tariff-driven panic we saw just 3 months ago. Remember back in February when tariffs slammed markets? The fear was real and justified. Companies were scrambling, supply chains were clogged, but now the story is different. Q2 brought a rebound nobody saw coming. Stocks are not just recovering, they're rallying. Nvidia, Amazon, Tesla, they've all bounced back stronger than ever. It's the kind of reversal that makes seasoned investors raise an eyebrow and rookies jump in head first.
But don't get too comfortable.
Beneath the surface, risk is still rising. Inflation hasn't disappeared, yields are creeping up, and geopolitics, from China to the Middle East, remains volatile. The current rally feels smooth, but smart investors are hedging. Historically, when the Fed pivots too quickly or markets overextend, corrections follow. Maybe not tomorrow, but eventually. The Federal Reserve is once again in the spotlight, and not in a good way. Fed Chair Jerome Powell is walking a tightrope. President Trump has made it clear he wants rate cuts fast. That's putting direct pressure on the Fed's independence, and while Powell's latest comments hinted at dovishness, many are questioning whether he's bending or breaking. Markets are watching every word, and so should you. It's a strange dynamic. The bond and stock markets are already behaving as if rate cuts have happened. Yields are falling, equities are soaring, but the Fed hasn't actually moved yet. This disconnect could lead to confusion and eventually volatility. If jobs data comes in hot next week, the Fed may be forced to hold off. But if it's soft, the door to a cut swings wide open. Either way, expect big moves soon. Thursday's non-farm payroll report is now one of the most critical data releases of the summer. A weak print could unleash a full-on rally and nearly guarantee a September rate cut. A strong one? Expect a shakeout. Add to that ISM manufacturing and services data, and you have a recipe for serious volatility in both equities and bonds. Let's talk commodities, specifically oil. Hedge funds are bailing fast. Over the last week, they dumped energy stocks at the fastest pace since 2024. Why? Oil prices have tumbled more than 10% on the back of eased Middle East tensions and increased production from OPEC+. Goldman Sachs says this is just the start, and if true, energy stocks could face more pain. But not all sectors are suffering. Defensive plays like utilities, healthcare, and even gold are doing well. Investors are clearly rotating into safety, especially as they prepare for what could be a volatile Q3. If you're heavily exposed to high beta sectors, it might be time to trim back or hedge. Surprisingly, some green energy names bucked the trend. Thanks to the Senate preserving key tax credits, stocks like First Solar, Sunrun, and Bloom Energy are up big today. That's an important signal. Even in a broader energy sell-off, policy can still drive performance. If this continues, clean tech could become a refuge in a shaky energy sector. Let's turn to crypto. Bitcoin is still holding steady near $108,000. That's a big win given all the macro crosswinds. Institutional flows are keeping it afloat. ETFs continue to attract money, and investors see Bitcoin as a hedge not just against inflation, but now also against fiat currency instability. Remember, when the dollar falls, crypto tends to shine.
It also helps that Bitcoin has political backing. Trump's strategic Bitcoin reserve program, which now includes over 200,000 BTC, is reinforcing the idea that Bitcoin is no longer just a decentralized asset. It's becoming part of a national monetary strategy. Love him or hate him, Trump's influence on crypto markets is undeniable. But crypto isn't without risk. Miner revenues are falling. Regulatory pressure from the SEC and IRS is mounting, and options markets show rising volatility into July. If Bitcoin breaks below 105K, expect a fast flush. But if it holds, and it likely will, 120K becomes the next target. Globally, markets are reacting to America's shifting stance. Europe and Asia are rising. The Nikkei, Kospi, and Stoxx 600 are all green. Foreign capital is flowing into risk assets. And with the dollar sliding, non-US assets are becoming more attractive. If you've been thinking about international exposure, now may be your moment. With half of 2025 behind us, let's step back. The dollar is down over 10%, its worst first half since the 70s. Gold is up 25%. The Nasdaq has rebounded sharply while energy stocks lag. And crypto is increasingly behaving like a legitimate asset class, not a speculative bubble. This isn't just noise, it's a structural shift. So what do you do now? Here's the alpha wave strategy. Diversify. Use gold, crypto, and strong foreign assets to hedge. Watch sector rotation. Energy out, green in. Stay nimble, especially into earnings season. And most importantly, don't trade the noise. Trade the trend. The big money is made by those who think one quarter ahead, not one headline deep. If this video brought you value, make sure to hit that like button, subscribe for daily insights, and drop a comment. What's your move this week? Buying the dip, rotating to safety, or doubling down on Bitcoin? This is Alpha Wave Finance. We're here every day to give you the edge in a world that never stops moving. See you tomorrow.